Hey there, so breaking news. As we expected, the Bank of England has decided to increase the base rate today from 2.25% to 3%. This is the largest hike in interest rates in over 3 decades. It comes after multiple recent rate rises as the Bank of England has attempted to curb inflation. So, meanwhile, Savills is the latest agency to suggest significant house price falls next year, although in its long-range forecast, it says the wealthiest will still see smaller falls and a quicker recovery than others. So the agency says that after over 2 years of strong growth, the average UK house price is expected to fall by 10% in 2023 when interest rates peak, but the prime markets will see smaller falls and outperform over the 5-year forecast. We believe there will be a growing divergence between cash and equity rich buyers, cash buyers, cash is king in this type of market, and between the mainstream market and prime markets where housing wealth is most concentrated. So on the assumption that interest rates gradually do ease back from the middle of 2024, which I expect they will do, Savills is forecasting that values will begin to recover and the average UK house price will rise by a net figure of plus 6% in nominal terms over the next 4 to 5 years. So there is going to be a bumpy ride ahead. By the end of the Savills forecast period, 2027, the average UK house price is still expected to increase to be at around £381,000, which is still a £22,290 gain. So short term, if you're looking at property as a short-term fix, probably not the best time to invest, but if you are looking for a mid to long-term investment, there's going to be some great opportunities coming up. Also, it's going to be a motivated seller's market, buyer's market, which means there's going to be some good deals around for those who do hold cash in the bank. So in terms of the new Prime Minister and the policy U-turns, naturally this has all put on, reduced some pressure on interest rates, but affordability will still come under real pressure. There are several factors that will insulate the market from the risk of a bigger downturn as seen after the financial crisis. Borrowers who haven't locked into 5-year fixed rates had their affordability heavily stressed until August this year. So looking at this, the combined with relatively modest unemployment expectations, signs that lenders are looking to work with existing borrowers to help them manage their household finance, one should limit the amount of for sale stock hitting the market next year. Long term, the Bank of England's relaxation of mortgage regulation over the summer has substantially enhanced the perspective of price recovery in the economy. So meanwhile, rental value growth will continue to outpace earnings growth in the short term because of the pronounced imbalance between supply and demand of rental property in the UK. Some positive news, the rental market is still strong and there's rental inflation in the market. The rarefied sort of market in central London's top postcodes continue to look good value in historical terms, particularly when seen in the context of the weaker sterling and the strong dollar at the moment. We do expect a price recovery in this market appears long overdue. This will help shield it from more significant price falls, though it increasingly looks like a stronger recovery in prices will not materialize in earnest before 2025. So this is some of the information we've recently received as of today. I hope you found this useful. Please click the like and subscribe button. We'll be keeping you up to date on market news, and take care and have a great day. Thanks.